Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get straight to the headlines. Indian markets trade in the green for the first time in 3 days, even as the Nifty continues to test the 10,000 mark.
IRB Infra falls as much as 5% in trade today after the CBI files a charge sheet against the company in a Pune court on charges of land grab and murder.
Infosys recovers from early morning jitters triggered by the settlement plea it filed with the market regulator SEBI on former CFO Rajiv Bansal's severance package.
Cipla is unfazed by regulatory hurdles faced by its peers in the US. CEO Umang Vohra tells Bloomberg Quint that he expects a quarter of the company's total sales to come from the US in the next 3 to 5 years.
Also coming up on the show today, a bunch of conversations. We'll speak to VG Kannan, CEO of the Indian Banks Association, to understand how far banks have gone in linking Aadhaar cards to bank accounts. The Supreme Court is due to hear a plea for interim relief now next week. We'll get your voices in on the recommendations for the GST Law Advisory Panel. That conversation we had earlier in the morning, a clip of that coming up. And Raj Bhalla explains the implications of Trump recognizing Jerusalem as Israel's capital. That conversation coming up on the show too.
But first, the markets. It's been a fairly strong rebound on trade today. Neeraj is here to take a closer look at some of those stocks. Neeraj, it's been an interesting bounce back, isn't it? I mean, after 4 or 5 days of weakness.
And after a really bad day of trade yesterday, so some would call it surprising as well. But yeah, we reached those key moving averages and have bounced back. There are some long positions as well, interestingly, in the session today, which was also quite interesting. And volatility is really dropped down. So if you look at the VIX, I think it's dropped some 40-50 bips in today's session. So 14.62, which is a 3.5% cut that we've seen in India VIX in the session today. Now, don't want to throw some levels, but the 2 times that the Nifty breached both the 50 and the 100-day moving averages. It's happened twice in this year. Very quickly, it rebounded and registered a 5.5% uptick in the subsequent pullback, immediate subsequent pullback. We're not saying that will happen, but hey, the last 1 year history seems to suggest that that's a trend. Let's wait and watch if this move has the legs to take the index up to those levels. So no, difficult, I would say, because of all that's happening and the Gujarat election verdict slated to come out. Just 2 pockets. No point in talking about large caps really, because it's across the board. I mean, yes, you can argue that autos are probably that one pocket that is standing out, but look at the top 5 or 6 gainers. There aren't enough financial names. It's across the board. So GAIL, Eicher Motors, certain IT names as well. So there's no pattern to the large cap gainers. It's across the board, as I said. Auto is standing out though, because Maruti, Eicher, Bosch, etc., all of them, but it's across the board. However, in the mid-cap end of the market, some interesting trends. The rice companies, and maybe go to rice exports or otherwise, but a couple of names even I hadn't heard of before. Chamandal, Setia exports, but that's up 20% 2 days in a row. There's LT Foods and a couple of others. Yeah, I know the smiles are. I'm okay with those smiles because 2 days ago, even I don't know what Chamandal, Setia export does, but hey, the stock is on a roll. LT Foods is up about 19%. So these rice exporting stocks are doing okay. By and large, good mood. The market breadth okay. Just a couple of stocks sulking, the likes of Shankara, etc. But those are probably isolated islands. It seems to be a happy place for now.
All right, Neeraj, thanks so much for that. That's the structure of the markets at lunch hour. The Nifty, however, bounced back after breaching the 100-day moving average yesterday. But what are the stocks that have contributed to the fall below that level, at least temporarily, and what has helped the Nifty stay in the 5-digit column? Agam is joining us with the list of those stocks. Agam.
Well, Ira, the Nifty is very precariously poised around the 100 DMA mark, and we're here to take a look at what are these stocks and what are these constituents of the Nifty which are around that mark that could actually influence the Nifty either moving above or below. And that, of course, is a very important technical indicator by a lot of analysts. So among the stocks which are still below the 100 DMA, we have Lupin, UPL, Bosch Aurobindo, and Yes Bank, 2 counters from the pharma space. Among counters which are around the 100 DMA, well, a lot of financials coming in here, and these were the ones which will decide whether or not you do see the Nifty hold above that mark. So Kotak Mahindra Bank, IndusInd Bank, and HDFC Bank, of course, Coal India and M&M among the others. Among the stocks that are holding the Nifty in the heavyweights, at least, we have Reliance Industries, SPI, and of course Z to a certain extent. But moving on, it's the financial sector which will be the most crucial, and in the financial sector, which has about 36% 8% weightage, well, we have about 16 stocks which are below the 100 DMA, followed by 12 stocks close to 100 and another 12 which are below, which are above. So the majority is towards, well, the negative, at least as of now. In terms of some sectors which are bearing down on the Nifty, we have the PSU oil marketing companies as well as the pharma stocks and half of the auto stocks. What's keeping the Nifty up? Well, the IT stocks. So we'll be watching out for that, of course, with the exception of Wipro, which has seen a lot of weakness in the near term. So we'll be watching out for these sectors as well as the financial sector specifically, whether or not that can help Nifty hold on above the mark of 100 DMA.
Okay, thank you for that. Let's move on now. The government today informed the Supreme Court that it's willing to extend the deadline for Aadhaar to be linked to essential services, including bank accounts, till the 31st of March. The government, however, is keen to extend the deadline only for those who don't have an Aadhaar card. The Apex Court will now hear the matter next week. Arpan Chaturvedi, who was in courtroom today when the government counsel made those comments, joins us now. Arpan, take us through, give us some key takeaways from what happened in court today.
That's right, Harsha. So just to put this in context and what today was all about is that the main challenge in this case is related to the whole Aadhaar Act and the Aadhaar scheme itself. And the hearing for that was initially scheduled to begin in the last week of November. But as we see right now, the Supreme Court, there are already Constitution bench sitting and which is hearing other cases. The case of Delhi versus Center just concluded, and now there's one more Constitution bench which is happening. So because of that, the hearing in this matter has not yet started. And that is why the petitioners are basically saying that either the hearing in the main Aadhaar matters starts and concludes before 31st December, which is the deadline for linking Aadhaar to various schemes, or if the hearing is not going to happen before that, then there should be a stay on the deadline and the linking should allow to be go ahead only once the Supreme Court has ruled on the validity of the Aadhaar scheme itself. How the government stand is that that they are willing to extend the deadline, but that deadline will only be for those who do not possess an Aadhaar card as of now, and those who have an Aadhaar card will have to go ahead and link it. And the petitioners, of course, object to that, and they say that the extension should be for all, for everyone, irrespective of whether they have an Aadhaar card or not. And that is the point of contention between the petitioners and the government. And that is why the Chief Justice of India, Deepak Mishra, said today that next week there will be hearing on Aadhaar, but that hearing will be limited to whether the extensions should be allowed and for who it should be allowed. The petitioners also said that the Chief Justice should mention today that when will the hearing in the final Aadhaar matter will start. They said that the CJI should say that it will start in January, but the bench said that that issue will also be dealt next week when the 5-judge Constitution bench sits and decides on the matter of deadline extension.
Thanks so much for that, Arpan. Critical issue, and also something that impacts all of us. In fact, all of us who have bank accounts, and in case you have not linked your Aadhaar number yet to your account, then chances are that you're being bombarded with text messages and emails asking you to do so as soon as possible. This, of course, because the current mandate is to link all accounts by the end of this year, which is not very far away. How successful have banks been in doing this linkage, and what are the troubles that they're facing? CEO of Indian Banks Association, Mr. V.G. Kannan, is joining us on the phone line. Mr. Kannan, thank you so much for agreeing to speak to us, because this is an important issue. Sir, can you give us any indication as to how successful banks have been, even if you don't have a number? Are 50% of the accounts linked, 40%, 70%? We have no idea, sir.
I don't really have the figures, but it's slightly less than 50. But the way it's happening, a lot of banks are getting requests for Aadhaar linking. And at least in the urban areas, most of the people are getting their accounts linked. The issue is, in many cases, we do not have a mobile number, especially the legacy accounts. And there we have an issue about getting the sending messages to them. So we are sending letters, we are sending messages, we are putting up messages in the banks. And all out effort is on to ensure that the Aadhaar linkage happens, so that there's no inconvenience to the customers when they have to either deposit and or withdraw money from the banks. So I think the effort is on, and almost on a daily, weekly basis, it's being monitored as to how the progress is happening. We do feel confident that in the short run, maybe if there's an extension, of course, it is a welcome feature. Even otherwise, we think that a substantial portion will be covered linkage will happen.
Mr. Kannan, you know, there is a substantial amount of confusion right now, particularly among customers who as Ira mentioned, are receiving SMSs on their phone saying go ahead and link. People are aware that there is a case in the Supreme Court which probably is discussing extending the deadline. What are banks doing to sort of allay this confusion, number one? And number two, if 31st of December deadline stays, and if I haven't linked linked the Aadhaar to my account, what happens? Is there any communication on that?
No, as of now, I think, the court cases are happening, but since the current mandate and Reserve Bank of India has also said that the linkage should happen. So therefore, we are going ahead. We are advising all the customers, and they are linking it. Yeah, technically speaking, what will happen is, in case the linkage doesn't happen by 31st and there is no extension, the account will not be operated till such time as the person comes and gives the linkage. And therefore, it is almost like similar to what happens when a pensioner is supposed to give the life certificate, and there's a time of 2 months which is given by which he gives a life certificate. If it doesn't give it, then he is supposed to approach any of the branches of the same bank and give it. So I think this could actually create some issues later on, but over a period of time, I think people will start linking their accounts with Aadhaar.
Mr. Kannan, I have two questions. One, I think the line was a little unclear. You said roughly for, about half, 50% of the accounts are linked. Am I right about that?
Yeah, slightly less than that, I would say.
Slightly less than that. So we understand that there is also, like you said, a wide divergence between urban, rural, public sector banks, private banks. Can you explain to us whether it's the private
one
and...
of the things is, in the case of public sector, in the case of urban areas, I think most of the people have the mobile numbers which are linked to the accounts. But many of the areas, we do not have the mobile numbers. So sending SMSs and all is an issue. And we are sending the messages to the residential known address. Many of them may not operate. See, today what happens is you can operate on your account in Bangalore, sitting in Mumbai. Because you don't necessarily have to remain there, because that is the residential address, and you don't want to shift the accounts for various reasons. And if the address where I'm currently residing is different, or I don't receive the letters, I may not be in a position to do it. But I think the awareness has been created by channels like yours, which will certainly ensure that people will start linking their accounts.
Okay, sir, I'm sorry I'm asking you some basic questions, but let's take the exact example that you're saying. You're staying in A city and you have an account in a different city, and let's say your Aadhaar card is based in the city you're living in. Let's say you're in the city of Bombay. If it does not link, then what recourse does the customer have?
The customer has to take his, if he has an Aadhaar card, which he's supposed to have it, and then he can go to any branch and get it linked. It's not an issue. Because he has to go and give a copy of the thing, give this number, and get it authenticated.
Okay. Just one follow-up as well. What in the case of joint accounts, would both the holders will have to declare their Aadhaar numbers?
Yeah, I think even in the case of mutual funds, the same thing happened. All the account holders will have to get their Aadhaar number. But primarily the main primary holders should certainly have it. And the second one, maybe that's an option available. We have not really gone deeper into it. We are presuming in most cases it will be a single account. But you're right. If it's a joint account, most of them have to give it.
Mr. Kannan, I have two questions now. One of the things that the Government Council has said in court, and they said this last time also, is that we are willing to extend the deadline for those who do not have an Aadhaar card. Sir, do you not think that will add to the confusion for banks? Because how does a bank, sort of understand whether they do or do not have an Aadhaar card? It'll sort of complicate the problem, won't it, sir?
No, in fact, I think probably the intention is to make them also to go and get their Aadhaar card. And some of them may not have the Aadhaar card. For example, you have got the non-residents which have been exempted. So they may have been mentioning those cases. Extension for the local people would technically mean that that's an issue of getting a link. But yes, they need to get their Aadhaar card at the earliest. So I don't know how it will be monitored. It will going to be a big task on the bankers to get themselves convinced that a person doesn't have an Aadhaar card.
Okay. So just one last question. So I'm just wondering, sir, is the IBA sort of, consolidating banks and bank requests and issues they are facing? Are you all taking charge of this process? Are you the nodal body, so to speak, sir, on this?
So far, none of them have raised any issues except the issue of volumes. I think there's no one else has raised the issue about the linking, because the linking is happening regularly on an ongoing basis. Of course, I'm not saying it's happening at the pace at which it is desirable, but none of them has raised any issues regarding the linking of the Aadhaar.
So appreciate your time. Thank you so much indeed for joining us. Vijay Kannan, the CEO of Indian Bank Association, clarifying some questions on Aadhaar. He says, as it stands, linking is happening the 31st December. Deadline stays unless, of course, the court rules otherwise. IRB Infra seems to be in a legal tangle. The CBI has filed a charge sheet against the company and its promoters for illegal purchase of government land in Pune. Nikki is standing by with details of this case and what the brokerages are making of this. The stock has taken a beating. Nikki.
So IRB Infra, this case goes back as far as 2009. Our RTI activist actually came across and said that the company has wrongfully acquired the land which actually belongs to that of MSRDC. But then back then in 2010, this activist was murdered. 2011, we saw the local police court filing a closure report. But then in 2014, again, we saw that Bombay High Court reopened this case and actually asked CBI to again go for the investigations. Ever since then, the CBI has been investigating this case, and it's only yesterday that the CBI has filed a charge sheet against the company and the promoter for wrongfully, illegally acquiring this land which belonged to the government. What does the company plan to do? It plans to take the legal course. It says that it's abiding by the law of the land and it's not done anything which is wrongful, and it does not impact any material business on this development. What MK has to say that the closure, now what brokerage MK has to say that this charge sheet, filing of a charge sheet implies that the investigation is now over. It expects the stock to remain under pressure for some time, and also it expects that the promoter will file a discharge sheet against the charge sheet which has been filed by the CBI. Now HSBC and Macquarie also pretty much say that the stock is expected to remain under pressure, and HSBC has gone on and actually downgraded the stock to a hold from buy and said that now no more the fundamentals will be driving the stock momentum. And in fact, it said that historically shares have been reacting negatively towards this development. It saw a good 30% knock back in 2012. And if you look at the momentum that we've seen in the past 5 days, except for the one that's seen yesterday, the stock has corrected nearly 11% for that matter.
All right, thanks so much for that, Nikki. That's IRB, been a talking point since the morning, stock down about 3%. Infosys has filed a consent application with market regulator SEBI. The technology giant says it wants to resolve allegations over the former CFO Rajiv Bansal severance package. Sajid Manga joins us to explain the situation. Sajid, this sort of came out of the blue, right?
Not exactly, because you had red flags coming in from Narayan Murthy about the corporate governance standards, and this basically puts the entire thing on the table, saying that there was indeed a breach of standards. So what Infosys has said is that it's filing for a consent application. As part of the consent application, it is seeking to pay a penalty or fine, irrespective of whether SEBI finds it guilty or not. But the issues here is that when Rajiv Bansal quit in October 2015, there was a severance agreement which was reached by the top management with Rajiv Bansal, and which did not have the approval of the NRC and the audit committee, which is a nomination and remuneration committee and audit committee. Further, Infosys failed to disclose such a severance agreement. It also failed to disclose when it stopped paying this amount to Rajiv Bansal, and then it also failed to disclose whether when it started arbitration proceeding along with to Rajiv Bansal. Remember, the entire severance package was around 17.38 crores, which is 24 months pay, and Infosys paid nearly 5 crores, and then it suspended payments, and that led to Rajiv Bansal initiating arbitration in April 2017. So it's now up to SEBI to accept the application, and once the application is accepted, it goes to the high-level committee of the SEBI before the level HLC decides what could be the course of action here.
Okay, so SEBI raised a question at that point in time, is it? I mean, that's my question.
So, it's very tricky here because SEBI raised question on the acquisition of Panaya. They did not go into whether they followed the governance norms of taking approvals here. Infosys is saying that there are allegations that Infosys did not meet the governance standard with respect to taking approvals and disclosures. So preemptively they are putting in an application with SEBI, which basically means that at that point in time the board and the audit committee and the NRC, everyone was there. Remember, Murthy came out and said, he was the first to flag off, saying that you cannot be paying a 24-month severance to any person, and that's a huge amount. And what is the reason why you're doing it? And he also said it could be tantamount to saying that you're paying hush money for this acquisition. So all those things were going on, and so the acquisition was under play and under scrutiny, for which it seems SEBI didn't have any concrete evidence against it. But the procedures which were followed for the severance pay and the agreement is something which will be under scrutiny.
No, the fact that they've openly said that they're going for consent means there is certain level of admission that there was some, moving away from procedure.
Yes.
That's an admission.
There was an admission that proper due process was not followed.
Correct.
That's to put it very simply. But it doesn't mean that SEBI can't go and investigate.
Right.
A consent application only allows the individual to pay a fine and get away with it. But SEBI can still keep the case open and then dig deep and see was there anything else.
But didn't they put out a press release at that point in time when the whole the severance pay was reduced or not paid off? When it was suspended, there was a press release at that point in time. Right? It was not conveyed to SEBI.
Again,
is the point.
It came out as part of your quarterly earnings disclosures which were there. But when it happened, they did not disclose it. Again, 5 crores is the amount which Infosys paid, and it again came through various reports, and then it was clarified. And then the management has been very quiet about it. Why it stopped? It said that they are looking at some procedures because of which they have stopped the payment. That's the criteria which was there. But the fact was that there was a huge resistance coming in from the shareholder promoters against such a pay, and Sheshasai in his Bombay press conference said that they were certain lacunas in terms of severance agreements, and so they appointed some outside agencies to benchmark severance agreements so that going forward there is no discretionary agreements which can be formed. So so there was certain shortfalls within what the previous management did, and I think it's a cleaning up act happening before the new CEO comes in.
Fair enough. Thanks, Sajid, for that. That could be the heart of what led to the exit of the CEO and the new board. But staying with Infosys, it wants to make use of disruption to its advantage. The company's chairman Nandan Nilekani wants to go big on artificial intelligence and Internet of Things. To go big in his first interview after taking over as chairman in August, Nilekani told Bloomberg that much of the new strategy has already been discussed with the incumbent CEO Salil Parekh, and Nandan's own role now is to convince all the big clients that Parekh is the best man for the job. Ruling out an active involvement of the co-founders in the day-to-day running of the company, Nilekani also said that it's always been a professionally run enterprise and there's no reason why that should change now.
All right. Promoters are the closest to all the action, know what's working and what's not working for a company. So when a promoter of a large cap company like Lupin starts buying their own shares every day, there's reason to at least take notice. As per BSE data, Lupin promoters have bought 8.5 lakh shares from the open market in the last 20 days. Darshan Mehta joining us with the details of those transactions, but also what it could mean. Darshan.
See, okay, so all the detail comes in on the stock exchange, and we've been noticing for the past 17 days, the promoters of Lupin are buying in shares of the company to the tune of 50,000 shares per day. So from November 13 that started, and continuously every day they're buying 50,000 on an average, and that actually number has actually till yesterday worked to almost 8.5 lakh shares. We need to watch now today whether they will buy or no. So from every day, they're buying. and that's the trend that's happening. And this happened post the warning letter that came in at two of their key plants. So 8.5 lakh shares have been bought from that day. So we try to find out what exactly is working for Lupin, what has gone wrong for Lupin. Now if you're looking at Lupin itself, the market cap has eroded significantly. The market capitalization of Lupin is now just 36,600 crores. This at one time was almost 90,000 crore market cap, was the second largest pharma company, now behind Cipla, Cadila, Aurobindo Pharma and Dr. Reddy. So it's now much lower in terms of the sixth largest market cap pharma company in India. Now the other traction is, the peak market cap is 91,000 crores. Now it's almost 37,000 crores. Now if you're looking at the valuations, not the most expensive, because Lupin is trading at 18 times, 17.6 times, which is much cheaper than the other peers like Sun Pharma, Cipla, Cadila, Dr. Reddy. Aurobindo is cheaper and it's always been cheaper. So valuation wise, it's not bad for them. But if you're looking at what brokerages have done, a lot of brokerages have turned negative over the past few months. So if you're looking at May, when 70% was a buy and 20% as a hold, now that 70% now has just become 39% and maximum has become hold, and a lot of people have started selling. So the trend for Lupin completely changed. It actually lost almost 60% of its market cap. So the analyst community turned negative. Now these are the negative comments. So Equarius is most negative, 715, Jefferies, SBI cap is 760. But if you look from the current market price, the worst target price is just 100 rupees lower, which means that now the analyst community also feels that the worst is probably over. Lupin is trading still below the Bloomberg consensus target price. What are the big four concerns for Lupin? Loss of market share in key drugs like Fortamet and Glumetza. Apart from it, warning letter at Indore and the Goa plant will actually dent the future approvals that will come in. Pricing pressure will continue for Lupin going ahead. And finally, the last point is the fact that there's no turnaround in their US subsidiary called Gavis. What works in favor and what the management might be thinking and why that is why they are buying. First of all, there was no data integrity issue in the warning letter. Probably the management realized, and post this they started buying. They're looking at site transfer for new launches, so they have a couple of good launches via site transfer that they can do it. Valuations are attractive, not the most expensive, one of the cheapest pharma stocks, large cap pharma stocks. And finally, they said that they're focusing on complex generics and specialty products. So that's pretty much why the management might be accumulating. We'll try to get in the management to ask them why they're doing it. But seriously, there seems to be a lot of accumulation, and we'll watch out. So 8.5 lakh shares already bought in the last 17 days. Will they buy today or no is anyone's guess.
Darshan, thank you for that. We are going to stick with pharma now. A late entrant into the US market, Cipla wants to play catch-up in the world's largest pharma market. A lot is riding on the drug makers. 3 big launches lined up for the next 3 to 4 months. Darshan caught up with the company's global CEO and managing director, Umang Bora. He says the aim is to get a quarter of Cipla's total sales from the United States in the next 3 to 5 years.
We know the number, right? Okay. I mean, we've got our own planning and we know the number and we know what range that number will be. Okay. I would probably say that we believe that the US should at least be 25 to 30% of the company, right, okay, in 3 to 4 years.
25%?
Yeah, 25 to 30% is what our aspiration for the company is in the next 3 to 5 years.
Okay.
And, the company is growing, as is the US, but that's where we want the US market to be.
What about margins? You've said that, at least for the near term, margins will be in and around this level. For this year, you've guided for it will be sub 20%. But do we see the possibility over the next few years that, again, you might inch back to the 22 to 25% mark?
Okay, so I'm going to say something which may be controversial, okay, right? I think so first of all, we've moved from about 14 or 15% back, right? And we've now at a range of about 18 or 19 in this year, broadly, yeah, right? And, our endeavor was to we wanted to target where the rest of the industry was, right? Mm-hmm. So you have, a range of companies operating today in the 24 to 28%, and 1 or 2 are higher than that, right? But broadly, the range was 24 to 28 of margin, and this was by increasing our R&D. So we moved from 15 to 19 by making R&D move from 5 to 8%, right? So I believe that normal of 24 to 28 today, Darshan, for the rest of the industry is possibly somewhere the 22 to 24 range.
Okay.
Right? Because post the US price erosion, etc., I think the industry is looking at a new margin normal. It cannot be the same margin normal that happened earlier. And so if it is 22 to 24, depending on the mix of how quickly the US scales up for us and what type of price compression we see in the US, I think Cipla will eventually get there, but we are in no hurry. I think if we are even in the 20 to 22 range, we're actually okay from a 2-year, 3-year perspective, because Cipla's ethos was never to be the largest margin contributor in this industry. Its ethos was also to do a lot of good. So, we'll be the first company along with Pfizer to sign up for oncology care in Africa, right? And we've done that. And not all of our business is driven to get margin up to be the best in the industry.
No, it's not being the best, Umang. It's basically, I understand what you say is there's a responsibility towards patient, but for a company, there's also a responsibility towards shareholders.
Correct.
Now, if you're saying that you moved from 15 to 18%, that's a good thing and you've achieved it. But still, it's subpar because I know that some of them have come down. So I'm just asking, if you're saying that 22 to 24% will be the new normal, you're still below that. So when will Cipla reach that level?
So as I said, we're looking at a 2-3 year window to get ourselves there.
And how do you intend to do it?
Well, I think it'll come out of our mix, our growth. It'll come out of complete control on costs, like we're doing even this year and the year before. So all of that will contribute to us getting there.
What's the pipeline like? Which are the new drugs that we can expect over the next 4 to 6 quarters? How many are probably a para 4 or large opportunities that you're looking at?
In the US?
In the US.
So US, I think we could see the para 4s are all public domain, right? So there's no point talking about them. We have a fair number of limited competition opportunities, but the thing is, Darshan, this is a moving target. Today, I may think it's a limited competition opportunity, and I might think that I might get approved in February, for instance, right? But till February, they might have 3 more who join the fray, right? So then it doesn't become a limited competition. But I'd like to believe that we have a fair number of limited competition launches, and we've guided to this that every quarter we'll see one. Right? We had said that in quarter 2 end we'll see one, in quarter 3 we'll see one. Unfortunately, the quarter 2 end moved to quarter 3. We saw 2 in quarter 3, right? So I think we are still guiding to the fact that we are hoping to see as an average 1 per quarter. So we will see 1 launch in quarter 4. We will see 1 more launch in quarter 1. So we have a list of this mapped out for ourselves, and I think that's.
But which are these large products that you're looking at?
So they may not be large in the way we know it, right? So for example, Pulmicort is a $500 million market today, right? But it's only 4 players. So there's a good chance that you can get to 25 plus million, right?
Yes.
So I think that's the type of target we are after, because from our base, we don't need a 600 million product. We don't need a 100 million product, right? If you were $1 billion, our worry would be different. We need a 100 million product to create some impact, right? For us, a 30 million product is a big product, right? From where we stand.
So which is the next product that...
so I can't give you a name, but I think there are quite a few in our pipeline, and we're hoping some may be on the institution size, right? Some may be institution size. Some may be in the $200 million mark today with no generic. Right? Now, there could be 3 generics by the time we come in, right? But those are the type of products here.
All right, coming up, we'll get a view on US President Donald Trump's decision to recognize Jerusalem as Israel's capital, the talk about the implications of that and what India's role could be in all of this. That's coming up.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
more than just business news, we're news for business people.
Back on Powerlines, let's take a look at the headlines at this hour. Bears finally take a backseat. Key indices put on nearly 0.5%. Financials make a comeback today.
Consumer confidence is headed lower, so is the confidence around employment, shows the RBI's Consumer Confidence Survey.
US President Donald Trump on Wednesday recognized Jerusalem as Israel's capital and announced that he would begin moving the US embassy there.
All right, before we get to all of those stories, let's dip back into the markets to see how they're doing. Pradeep is here with us. Pradeep, what's the structure of the market looking like?
Well, looks like at least a pullback, relief rally, I would say, for bulls. Markets were a bit oversold, I think more so, I would say, for some of the global markets, and therefore, once they have started to recover, we have only followed. But cues are still not very positive because, the commodity markets have not yet stabilized. There could be some more correction there, and then we'll have to see what really happens. If you look at what is good to see is, some of the leading stocks like Maruti once again moving up. Yesterday we saw Reliance moving up. Now these are some of the stocks that can really drive the market higher. So if the market recovery was backed, more by the laggards like the IT companies or some pharma companies, we would have had more concern. So this is one positive. And also there is some news flow, like GAIL announced a 6,000 crore rupees capex plan. On the back of that, you have all the gas stocks doing well today. Then Avenue Supermart moved up after a block deal that has happened there. You also have rice stocks moving up on the news that there could be more export demand coming up for these companies. So there are all these pockets which have participated in this recovery. But we'll have to see whether we can really sustain, there could be some pressure that may start to build up if we move up by another 50, 60 points here on. And that would probably be the real test. So maybe in second half tomorrow or early Monday morning, we'll actually see the bears returning once again and trying to building some short positions at higher levels. But for now, going is good, positive market breadth, and it's actually positive all across the board, I would say.
Good rebound today, Pradeep. Thank you so much for that. Structural reforms have spoiled near-term visibility on most macro parameters. That's the word coming from Nilkan Mishra of Credit Suisse. He's, however, overweight on select sectors like metals, PSU banks, and IT. Samit is standing by to give us some key highlights from that report. Samit.
So Credit Suisse has come out with this India market strategy report, and in that report they're saying that the structural reforms have weakened the near-term visibility on most of the macroeconomic parameters. Also they're saying that weak agricultural income growth may suppress broad-based consumption demand, and along with consumption demand they're saying that investment demand is also expected to be weak on unclear outlook and low utilizations. Now for the first time in a decade, though global growth is tepid, estimates have not been revised downwards, and Credit Suisse is expecting this trend to last for several years. Now, on valuation side, they are saying that the market as a whole is not expensive on a relative basis, and they're expecting a double-digit EPS growth in financial year 2019. Now, they have turned overweight on sectors like energy, metal, PSU banks, and IT, and they are underweight on sectors like NBFC, cement, discretionary spending, and staples. On the top outperformer side, they have stocks like SBI, ONGC, Tata Steel, and on underperformer side, they have stocks like Bajaj Finance, Ultratech, and Dr. Reddy.
All right, Samit, thanks so much for that. I think one of the things that Credit Suisse also talked about was that they are turning positive on public sector banks, and that is linked to the kind of recap that has been done, and also the decision, or rather the pronouncement from RBI Governor yesterday saying that the reform will come together with recapitalization. This will not just be a recap package. Speaking of announcements from the RBI, they cut the merchant discount rate for debit card transactions yesterday. The merchant discount rate has been brought down for small merchants in particular, and differential rates have been introduced. If we put those up on the screen, you can see what the new rates are. Also, QR code based infrastructure will attract lower merchant rates from here on. The idea is to push up card payments further, but there could also be some concerns whether lower MDRs would discourage those who actually put down this infrastructure in the hope to earn from it. We've got a couple of divergent views coming in from two brokerage houses, so just reading those out for you. Kotak Institutional Equities in their report said that the RBI RBI's move to reduce merchant discount rates for debit card transactions for smaller merchants and QR code-based transactions will likely bode well for broad-based and asset-light adoption of cashless modes of transaction in the medium term. However, volume is unlikely to make up for the shortfall in reduction of fees in the short term, and hence the near-term impact could be marginally negative for a few players like Axis Bank, HDFC Bank, ICICI Bank and SBI, all of whom have debit card fees, which is a key area of growth for them. Morgan Stanley took a slightly more optimistic note, and they said that we see RBI's reduction in debit card charges as a step in the right direction towards higher digital payments. It will reduce bank charges on card transactions, but this would be more than offset by the pickup in volumes and lower costs.
All right, the Reserve Bank of India released its consumer confidence survey with its bi-monthly monetary policy yesterday. The survey, conducted among a little over 5,000 consumers in 6 cities, shows a further drop in confidence in the last 2 months. Shraddha has been going through that report. Shraddha, so what's the main concern here?
Well, yes, so if you look at the survey, what it's throwing up is that the mood of the Indian consumer isn't very upbeat right now. So if you look at the red line, which is the current situation index, you will see that the trend has been that of a decline. And not only that, the drop in the latest survey also shows that there's a significant drop coming in from the previous survey in September, where the index was at 95.5 to it has fallen to 91.1, and it has remained in the negative territory for the last 4 surveys itself. Not only that, even if you look at the blue line, which is the future expectations index, which gives you a 1-year outlook of sorts, that also has been, it has remained in the optimistic zone, the positive territory, but that has been declining as well. So what's the reason for that? Well, the survey says that it's mainly because of the drop in optimism when it comes to the general economic situation, and also because of the employment scenario. That's the more important one. So if you look at the employment variable, it's been continuously declining and is now at 19.2. Not only that, even if you look at this variable in terms of the future expectations, you will see that the down green arrow means that the number is a positive one, but the extent of positivity has declined from the previous survey that was held in September, and that's of course not good news. In fact, the GVA data also threw up the fact that consumer expenditure has been declining, and of course that has larger implications for the economy, because so far it was consumption that was holding up economic growth because investment cycle was depressed. And secondly, you do need that consumption demand to sort of hold up so that it can lead to a pickup in the investment demand. So not very good data points or outcome as far as the RBI survey on consumer confidence is concerned.
Absolutely, Shraddha, bang on. Thanks so much for explaining that. The GST Law Advisory Committee, meantime, has suggested more than 100 changes to the Goods and Services Tax Act. The recommendations submitted to a Revenue Secretary on Tuesday will now be placed before the GST Council. Menka Doshi caught up with Prateek Jain of PwC and MS Money of Deloitte to understand 2 of the most important reforms suggested: the abolition of the reverse charge mechanism and an alternate way to the e-way bill system. Listen into a slice of that conversation.
When you have a reverse charge, when you buy from unregistered dealers, small players, you have to account for that tax as a purchaser. So as a purchaser, as a company, I'm reluctant to buy from those small businesses, and therefore small businesses are getting out of business, which obviously was not the intention. So if you continue with this provision, then the reluctance to buy from smaller vendors will continue, and therefore we have also recommended to the government that should be done away with. The fact that it has been deferred to March, that means that government of course is contemplating as to what to do. So it should be done away with. It's an additional compliance burden and with no additional benefits.
I don't know if you agree, Mani, but this was supposed to be part of the fundamentals of GST in terms of base widening. You take away this, are you not hurting the very core of what GST was attempting to do in this economy?
Yeah, so while there is a lot of pressure on people not to go ahead with reverse charge, I would say that it is altering the fundamental architecture, because GST was expected to bring a lot of people into the value chain who were not earlier in the value chain, and this was the matching concept was one way of getting them on, and this was another way of getting them, on. I would just add one point is that what we are talking is only doing away with reverse charge on transactions with unregistered dealers. So while there has been a lot of discussion on doing away with reverse charge altogether, that I don't think is going to happen, because even earlier under service tax we were having reverse charge. All of that has been migrated to GST and all of them continues.
So if you
there is some amount of reverse charge already.
If you do away with it only for unregistered dealers, who does it stay on for?
It stays on for very large number of other players where there is where there are two categories. One category is where the service providers are many and the service recipients are few. For instance, in case of insurance companies, or in respect of mutual funds. Second category is in respect of those where the government administratively feels a huge burden. So those categories have been there in service tax for a long time, and they have got migrated into GST.
So you expect that those will persist, but
those will
the
continue to
unregistered guys will go off the net?
I don't think they will go off the net. My sense is this has to be calibrated, so we can give it maybe 6 more months. Maybe we can take it after a year, but at some stage this has to come, because we are altering the architecture. The objective is to get more people into the tax net so that the rates come down.
Are we altering the architecture? So this was not the initial design of GST, because initially they said purchase tax will be done away with. What is purchase tax? If you buy from somebody unregistered, then you do pay purchase tax. Now this is a backdoor entry of purchase tax to my mind. So I agree with him that other reverse charge like transportation, etc. would continue. But purchase from unregistered dealer, there's no logic. I mean, you will have a situation where larger businesses will not buy from smaller businesses, which is really not the intention of the law. So I have a slight disagreement on this one. That
we'll agree to disagree. I'm sure the council will be listening to both of you on this, given that you all spend an inordinate amount of time debating the many changes to GST on this. E-way bill should be deferred till 2019, or bring in an alternate method for e-way bills. Critical for the logistics industry. Everything I'm told, and I know, Prateek, we discussed this last time when we were talking about this, is that the transportation or logistics industry is just not equipped logistically, in terms of being able to generate e-way bills, and probably won't be for the next 6 months, year, maybe even 2 years. Should we do away with this altogether? Again, a fundamental aspect of GST.
Yeah. Now, e-way bill is certainly not a fundamental aspect of GST. It is actually going against the grain of GST. Because GST was expected to make movement of goods across states seamless. And if you look at it in a very simple way, when people move from one state to another in India, they don't need a visa, right? When services move across from one state to another, it doesn't require any form. So why is there an artificial restriction in respect of goods when we are saying it's one country? And to a large extent, whatever the e-way bill does, the same purposes are fulfilled by the tax invoice. And the tax invoice is available on an electronic database for any tax authority to see anywhere in the country when the goods move. So why are we adding one more piece to the documentation trail, calling it an e-way bill and making it a control mechanism? Because the worry is not on e-way bill. The worry is the moment we have e-way bill, we have something called check posts, which have given, I would say, the whole country an extremely bad name, and you would be reading a lot of things on, check posts. I mean, just to share with you, we have a very famous check post in Kerala, which is between a place called Coimbatore and Palghat. And on any given day in this check post, you will find approximately 2,000 vehicles waiting. If you are driving, you need to budget 1 hour to cross a 1 kilometer stretch. So the intention is to do away with checkposts, altogether, and e-way bill is a mechanism to do that.
Okay, so not just defer, kill is what I think Mani is suggesting.
Absolutely.
Don't even consider e-way bill.
I agree with him.
You agree with him on this,
yes,
right?
so I think e-way bill way is not a good idea, because
But there was a purpose to suggesting e-way bills, which is for states to be able to keep track of the movement of goods.
But why do we need to keep track? So that logic is also not there. So if goods are moving from Maharashtra to Karnataka, by way of IGST mechanism, you have collected the tax already. Earlier, Karnataka had to track it because, they have to collect tax later. Okay, now there is no difference of rate of tax in two states. So, diversion of trade. So the government logic is that, a lot of people will just move without, with fake invoices, etc. How do we need to keep a check?
They needed a second system of checks.
So there are 2 points to it. One is that you have a large machinery of state governments, which practically don't have anything to do right now. So use them for this. and interception, vehicle interception, intelligence. Those are things that you develop.
So random checks,
yes.
not.
And second is that if you have a tax invoice, as Mani said, if you have to have this kind of system, why don't you ask the businesses to put the tax invoice itself onto the portal before the movement happens? So use tax invoice. So let's say the vehicle is stopped. You want to see the veracity of the tax invoice. You check on the system because tax invoice itself has been uploaded. So that you can do rather than having a e-way bill system.
Interesting conversation on the nuances of GST and the possible sort of changes to that. Let's move on now. In a remarkable shift in foreign policy, US President Donald Trump recognized Jerusalem as the capital of Israel. In an announcement last night, he said he will start the process of moving the US embassy there.
After more than 2 decades of waivers, we are no closer to a lasting peace agreement between Israel and the Palestinians. It would be folly to assume that repeating the exact same formula would now produce a different or better result. Therefore, I have determined that it is time to officially recognize Jerusalem as the capital of Israel.
While Israeli Prime Minister Benjamin Netanyahu welcomed the move, Palestinian Authority President Mahmoud Abbas said that the announcement was tantamount to a U.S. withdrawal from the peace process. 8 Security Council nations have demanded an emergency meeting to discuss President Trump's decision.
We caught up with Raj Bhalla, professor of University of Kansas and senior advisor at the Denton's law firm, to understand the implications of this move. Listen in.
Well, first, from India's perspective, India has long enjoyed excellent relations with both Israel and the Arab states across the Middle East. So one challenge now for the Prime Minister and the Foreign Minister is to see what should they do. Should they follow suit with the Trump administration, or perhaps much more likely, should they join the chorus of all other countries, France, Germany, Turkey, China, Russia, the Saudis, Jordan, as well as Pope Francis. All of them have said that this is not a good move and reacted negatively. So from the Indian perspective, given the long-standing good political relations and healthy economic relations, including workers in the Gulf, this issue does matter. Then I think you put your finger on it perfectly, that this raises the question in minds across the world. Can the United States any longer be looked at as an honest broker? It's very interesting if we go back a little bit in the history. In 1947 and 1948 and 1949, the United Nations General Assembly actually passed resolutions declaring that Jerusalem ought to be considered a separate body, basically an international city, because it is the holy home to the 3 Abrahamic faiths, Judaism, Christianity, and Islam. And the United States joined in 2 of those resolutions, saying, yes, it ought to be an international city. In the 3rd one, they said, no, it's not going to be possible given the outcome of the 48-49 war. But since 1949 until perhaps today, the United States has consistently maintained that the final status of Jerusalem, including its boundaries, should be subject to international negotiation.
Well, Professor Bhalla, to withdraw from that situation disrupts the Middle Eastern peace process at a time when we've in fact seen festering violence across the Middle East and, several local wars. What do you make of the kind of implications this will have across the world? I know that several leaders have come out and said this might lead to an escalation in violence, and they've also accused the U.S. of quite literally withdrawing from the peace process.
Yes, and that even presumes there is a peace process. Many observers say the peace process basically ended, at least temporarily, in the 1990s, and that the U.S. has basically withdrawn from it and today openly sided with one side. But let me step back and let offer a perspective in which I hope sort of cooler heads might prevail, and that is to view this differently, whether you think of it symbolically or legally. If we look at it symbolically, then the potential for escalation and, God forbid, violence is there. But if we look at it legally, carefully, and we say that the U.S. has not actually drawn boundaries with across Jerusalem, and it is truly left open the possibility of final status talks. If we can try and focus on some of the subtleties, then it's possible that maybe cooler heads will prevail, and it won't contribute to an escalation of violence. I would say, though, also, and this takes it back to the symbolic point, and part of the great concern is, in my own opinion, this move it does nothing to enhance America's national security, because it will be looked at symbolically on social media by extremist groups as a tool for recruitment. Why would the U.S. want to give a tool for recruitment, even if it's purely rhetorical and it's not correct legally or factually? Why would the U.S. want to give a tool for recruitment to extremist groups? That's a big question I think the administration has to answer.
That's an expert voice on the U.S. decision to recognize Jerusalem. We're out of time on the show. Thank you so much for watching.
Good off. Countdown is up next.
Are we live?